you went from 50 to 54 with 6 facilities.
Yes.
That's incredible. You 50 to before you were 55, you're going to probably own, 10. You'll probably have bought 10 plus by the time you're 55.
That's the goal.
That is absolutely amazing.
We are making offers on everything. We are making offers on everything that we feel works for us. Just go do it. Go do it. Don't wait. Don't think that you need to know everything about it, because you're never going to know everything about it. Find an excuse how to do it. Just go and do it. Go buy your first facility.
Welcome everybody to Self-Storage Income. And today is going to be a great podcast because I have an interview and I'm really excited to bring Russell on. He is the owner and founder of Safe Storage USA and has such a fascinating background. I love the interviews, as a lot of you know. They are not only insightful, but I love the change in perspective. So these are my favorite podcasts to do. So with that, Russell, how's it going, man? Welcome.
Hey, man. Thank you. Thank you for being here. And super excited to be here, man. Appreciate it.
I'm really, excited that you accepted. You're in our inner circle. And so we get to talk and we obviously see each other every week or every other week. But you have a very interesting background. You've done a lot. And I think you have a very interesting career change that was wildly different than what you were planning on doing. So I'm really excited to dive into those things. So thanks for coming on.
Well, thank you for having me once again. I'd like to start this by saying big congratulations to you, man, on your second edition of your book. Fantastic response. I've seen the reviews. I wrote one as well, and lots of luck to you, man. I read the first book. I read the second book. I definitely want to dig into the book with you and the fact that it's 100% bigger than the first one. So I wanna ask you a question or two about your book. Do you mind?
No, go for it, man.
All right. So I have your book on my desk. Your original book. I bought it. I read it. I think I read it overnight, because that was the time where I was like really learning about stuff, and I love how logical and how easy it was presented, and the info and how valuable and fantastic. And all of a sudden I see a new book that is 100% more than your previous book. So here's my question to you. What changed in the last 2-3 years that you had so much more to add to your book, making it double the volume, double the pages, and it's 100, if not more than 100% more than your original book?
Yeah. It's 430 pages, and the other book was less than 150. So it's a textbook. It's twice as much. So this is a good question. There's a couple things. After COVID, right, the world obviously changed. And this was written a few years before COVID. Now, what had happened during COVID and the interest rates and markets was a few things. That, first of all, we started to return back to a normal cycle, but we were also in a cycle that the vast majority of storage investors have never seen before. You're talking the vast majority. And so in this book, I updated on all of those kind of things, right? But we dove super deep into underwriting, valuations, and looking at spreads in marketplaces. And we gave case studies and management, and we updated with technology. So in the last 5 years, the markets have changed, running facilities have changed, the technology has changed.
Everything, yes.
And so it's like a lot of people that may be questioning, first of all, is storage still good? But also then questioning, how do I do this and make it successful in today's environment where your book was written in an old environment? And we pulled out all the stops. I mean, the amount of P&Ls, case studies, numbers, it's more in depth. And we dive really deep into some of these topics that the people are the most scared about. Making an offer, closing day, valuation. How do I come up to a value? How do I really understand demand where you have different things going on? New supply coming on board that's in fill up. So I give a lot of my concepts that I teach, obviously that rate runway, things like that. So it is way more, and it's way more updated. But then two, it dives into the issues that we are having today that you can take advantage of, and then how to do it. because it is such a special time.
Well, listen, you're a master of storage. I consider you the master. I learn from you every Thursday on our calls. I've been a part of a number of mastermind. What I've learned from you is amazing. I think it's you teach me more of an art than a science, and I'm still blown away how you evaluate the location and how you go about supply demand, and I'm re-listening and re-watching the videos just so I can grasp that concept. I think it's the most important concept. So thank you for that. And listen, I can't wait to read the book. It's probably going to take me a little while, more than just one night to read it. My name is Russell Nersesov. I am the managing partner, one of the managing partner of Safe Storage USA. As you know, we raise money to buy facilities. We buy and operate facilities across the United States. We've been doing it for about 4 years. I started in the 2020, right before the COVID. We got interested in the asset, and been doing this 100% of my time ever since.
And you didn't start out this way though. You didn't start out as a real estate investor or especially a storage operator. So tell everybody where you started your career and what you were doing.
Well, actually, yeah, I'm a chiropractor by training. So I spent 23 and a half years in practice, and ever since I sold my practices in 2019. Due to injury in both of my shoulders. It is a physical job, after all. When you adjust 100, people a day, it really takes toll on you. So at that point, I realized I couldn't do it anymore, and I was looking for an opportunity. And talking about being investor in real estate, I've invested in real estate for many, many, many years in different ways, shape, or form: single family, multifamily, land, conceptual, healthcare, real estate. So I was always in the real estate, but not 100%. And I was always coming in either as an LP, a limited partner, or a part owner of the deal. But 2019 was a critical, crucial year for me, actually. So I sold my practices, and I was looking around, and I was looking for an opportunity. I was still young, relatively young. I was only 50, and kids in college and wife, mortgage. The regular story. I had to find a way to generate income, and I got involved heavily into multifamily investing. But then I realized that multifamily was not going where I wanted it to go. It was getting a little too bubbly for me, and I've seen investors buying the property just to sell to another investor, so the other investor can sell it back to you 2 years later, and I started to get very, very cautious about the asset, but was looking for another asset where I can use all the knowledge that I obtained, while I was in multifamily. And I came about the Michael Wagner, who runs the mastermind, similar to what you do. And I got involved in that mastermind, had to learn really fast. And the rest is the history. I just went from one mastermind to another, learning, building my network, learning about the asset. Immediately, I've learned one thing, if I can say that, you got to do it. You got to get into it. You got to get into it 100%. There's never a point when you know everything before you make a move, before you buy your first property, but you got to just go in and do it. So I went in, I got my partner involved, David Hanses, and we went in and we bought a pretty large first deal. It was about 42,000 square feet in Midland, Michigan. And everybody was like, no, it's too big for you, man. Don't do it. It's too big. It's crazy. It's very labor intensive, this and the other. But, we got lucky and we bought a very good property, and we learned a lot on that property. And from that point on, we just kept buying more properties and selling more properties. And, we've done about 6 deals in the last 3 years. And we purchased about 6 deals in 3 years. I wish we could have done more, looking back, and I wish I knew back then what I know now, but unfortunately, that's not the way it works. We all have 20/20 vision, looking backward, right? So, yeah, we ended up with about 6 deals, and it was difficult to buy anything last year. I'm sure you feel the same way, and it was super difficult to buy anything last year. I still feel it's difficult to buy this year, but last year especially. So. But you know what? Interestingly enough, we had a lot of people that wanted to buy our deals. So we disposed of 4 deals within the last 18 months. We sold them. We wanna sell when everybody wants to buy. We want to buy when everybody wants to sell. And it just worked out that way. And so currently we're in acquisition mode. We're looking for an opportunity. There are some opportunities. It's still kind of difficult to find a deal that really works. And I'm sure we're going to talk about this later on. But current state of market and where the buyers and the sellers are, and that disbalance where we need to find that happy medium somewhere. But I think we're still in a discovery phase where not a lot of things make sense.
Let me ask you this, because I want to get into the market and everything, but first I got to ask you, what age were you then when you started investing in storage 3 years ago?
Well, I'm 54 now, so I was about 50.
I love that. That's awesome, because I think, it's funny, especially on the podcasting world, things like that. I get asked a lot by people. They're like, I've already got my career. I've already got this. Should I even be doing this? Should I even be looking at this? And you went from 50 to 54 with 6 facilities.
Yes.
That's incredible. You 50 to before you were 55, you're going to probably own, 10. You'll probably have bought 10 plus by the time you're 55.
That's the goal.
That is absolutely amazing. So I first just want to say congratulations, especially in the time that you were buying it. This was not easy times in the last 3-4 years. COVID, everything else was going on. I mean, the markets were in uproar. A lot of people froze, and a lot of people have. And you've been buying, selling, and you're still buying throughout those cycles. So first and foremost, congratulations. I think it's a great lesson for people to learn and understand.
Thank you, first of all. But, one thing that my partner and we feel very strongly about it, that we need to be able to function in any market. Because everybody is a hero when the market is easy. And everybody is a hero when the market goes up and appreciates overnight, and you buy it at $1 million, selling it $2 million 12 months later. That's not really investing. I think the art of investing is being able to function and operate in any market. So we want to stay active. We wanted to be in the industry. We want to stay active. We want to grow the network. We want to grow our base, the investor base. And that was the reason why we kind of wanted to. I mean, once again, looking back, there was a lot more deals that we should have paid more attention to. And but unfortunately, or fortunately, it didn't happen. But we feel strongly that this year and the next year is going to be where we're going to be able to, the goal is, it's funny you said that, but the goal is to own 10 facility by the end of next year. So we kind of want to get to that point, and we're looking at portfolios. I've seen some new deals coming up to the market. Speaking of the market, if you look at Craxi, I think there is the highest number of deals available today in the market altogether. It's over 1,000 deals available. About 6 months ago, it was 500-600 listings. Right now, we're looking at a lot more deals. I'm not saying that a lot more deals, meaning a lot more opportunities where they make sense, but there is a lot more to choose from, and we're staying very active. We're underwriting deals daily. We have an underwriting in the office, and so we do 2, 3, 4 underwriting per day. And, we're just looking for that golden opportunity where we can make money for our investors.
It is a big change from last year, because last year there was half or less of the deals that we saw, because deals dropped in 2023 by 80%, but
yes.
Out of the 20% that were on, they were wildly off the market. So the thing about last year was not only was there a fraction of the deals left, but the deals that were on were still trading as if it was 2% interest rates. So they were so above and beyond, nobody could even make them work, and almost all those deals were, they were just taken off. They never even traded. And the ones that did trade, they did not trade at asking price. And I think we've seen a step forward with sellers where we have more sellers, but more realistic sellers. It's like 22 and 23, everybody was like, listen, you can't sell it. So I think that we have way more sellers out there, but I think we do have way more sellers that are going to be reasonable, because they know we've had a year, nothing traded at these prices, which is nice. It doesn't mean that they're where we need them to be, but it's nice we're moving in the right direction.
Technology is the name of the game, and how you operate your facility and the efficiency at which you can operate will depend on the technology you use. Your property management system, what it allows you to do, and what you have access will determine the outcome of how that facility performs. That's why we go with Tenant Inc. with their product Hummingbird because they are the best in class. When dealing with automation, when dealing with move-ins, customer acquisition process, improving my online acquisition process, they are bar none the best. So if you are looking to automate your facility or operate it in a best in class way, make sure you guys are looking at Tenant Inc. and their product Hummingbird. The link is in the description.
Let's unpack this for a moment. Along with realistic sellers, I believe we have a lot more realistic brokers.
Yes.
Because brokers are the ones, basically, they are liaison between the seller and the market. So I think, us talking, and, I speak to brokers daily, I'm sure you do too. And I feel they do want more realistic offers. And they actually ask us to come in and say, hey guys, submit an LOI. Let me show to the seller what the market value is. So if I get a couple of LOIs, and I'm going to be able to convince the seller to be a little bit more realistic. So I think working with brokers today makes a lot more sense because they actually on our side, they want the deal to happen. And like you said, the deal volume dropped tremendously, somewhere between 60, 65, and 80%. So in terms of our ability to find a deal that works today, realistic sellers, yes, but most of them still fishing, most of them still in 22, 23, with the price of a very high 5.5, 575, 6 caps. That's what they're looking for. But I think a lot of deals are not trading because of that. And those that do trade, they're being retraded right before the closing. So in order for that not to happen, we kind of want to express this to the broker ahead of time. This is where we're coming in. Do you want us to come in at that number? Do we have a chance? Is it realistic? Is the seller realistic in terms of his expectations? Or are we just fishing? Or, he's just looking for... So I agree with you 100%.
And we've seen that a lot.
Yes.
Like the retrading is out of control right now. And we found that, we even talked to brokers. We're like, listen, what we're doing, and this is really important what you said, is that we're trying to avoid that. Meaning that a lot of brokers last year got burned because people put in offers $3 million, then they retraded in the final hour at $2 million. And the brokers are like, whoa, and if those assets most likely didn't trade, right, at all. But then what happens is the broker's worst nightmare. The owner is now ticked. You wasted his time, and so they're not going to list the property. So the broker just lost the deal that they'd already put all the work in for, and then they didn't get paid. So brokers hate when people do that to them because it's a bait and switch, right? So I find that it's really good to be very clear and upfront with the brokers and say,
ahead of time,
this is where we are. And what we try to do is say, this is where we are without retrade, everything else like that. Because the other people may be giving you an offer that may be higher than ours, but it doesn't mean that it's real. And then we also outlined the reasons why we would retrade. So if there is a retrade, this is why, which we don't do as a firm. Outside what was presented is not real. So if you say there's $50,000 in CapEx and a building's falling over, obviously that doesn't work. Or you say that it's in great condition and we find out that the roofs are actually broken or leaky. Or you say that taxes are $50,000 a year and we find out they're $150,000 a year. So outside the information being given being wrong, we try to make sure they understand. So if this stuff that you provided is correct, we don't need to worry about this. And we'll come with a legitimate answer. It won't be the highest, but you're not going to get those games played. That actually works, I think.
I think so too, because the broker's most important part for the broker, I believe, is to know that you're going to be able to finish that cross line, that you're going to take the property to the closing table and everybody gets paid. So is it always the highest offer? No, but it's somebody that they have trust and relationship with, that they believe they can take the property over the finish line.
Because at the end of the day, to the broker, you got a $3 million property. Whether that property sells for 3.5 or 3 million matters way less to the broker than it actually trades. That is the most important thing. They don't really care about that $500,000 difference. So if they look at you and think that you're a risk, they're not putting that deal with you. They'll tell the owners, don't put it with them. I don't think that they'll trade. Go with another offer, even if it's lower. So that's really important in today's environment, especially when looking at deal flow.
100%. Adrian, let me ask you a question, if I may. On those deals that you see, and you do see a lot of those deals still being asked 5.5, 575, 6 caps, who's buying them?
I'm not seeing anybody buy them. We're not seeing them trade. So
They don't trade at all. Okay.
yeah, if they trade, it's not at the listed price. So we see it, and then all of a sudden they're putting out, oh, it traded, right? And we sold this and everything else. They'll never put the sell down on. So we'll ask, did it trade at asking?
I usually call the broker to ask that. After I get the email, we just sold, I usually call the broker and say, what was it sold for? Because it was asked for a ridiculous number. What was it sold for?
And we're not seeing none that we're trading at those asking prices. And we've gotten burned by this, where we told them, we're not even going to put an offer in, we're not going to do anything, and then it actually traded at the exact number that we came up with, which was substantially lower. One of them, they were asking 2.5. They said we would not go below 2 million, and we were only at 1.4 million, so we're walking away. It traded at 1.4 million. Even though they said under no conditions would we go under 2 million. So we're seeing that happen a lot. And I think that's really important for people to understand, because they're like, who's buying these things? Outside first tier markets, class A assets, though, I'm sure that if you had an asset that was listed at a 5 cap in a first tier market that has, it's going to trade at that, right? But outside those big markets, everything, I'm not seeing it. I haven't seen anything. Even in those markets, I don't think they're trading at asking. I still think they're trading below. The spread is just not nearly as big. The farther you move down, if you're in a third or fourth tier market, and some people own in fifth, sixth tier markets, we're not seeing those traded. I mean, you're talking 8 caps plus. You get into those really small markets where there's not even a gas station kind of stuff. It's like, those are, 8 caps, 9 caps. So when those get listed at 5, 6 caps, we know that they won't ever trade because most of the time they can't, right? Meaning you'll never get financing for them because a bank will never allow you to trade. But another problem is the capital expenses and cost in those facilities. All of a sudden, you're like, if I have to, with that margin, with that interest rate, there's no room for error, which nobody's really following right now. So banks won't lend money on them, anything else. In first tier markets, you don't have that nearly as much.
Well, what's interesting? I was talking to some of the brokers, and they said the other thing that we have going for us meaning the buyers in this market today, is the fact that there is not as many buyers today as there were last year or 2 or 3 years ago. I was given a number. I was given actually the exact number. I was talking to my broker, and he said that we used to call about 30, 40 groups. Now we only have 14 to call. So that means that there is less competition, and at some point that the buyer-seller delta that between the bid and ask should somewhat narrow, because there's just not enough.
It's narrowed since last year, but not nearly, because a lot of these small markets, we're seeing a spread of 300 plus basis points from 2 years ago. So somebody was like, well, I could have gotten a 5 cap or not. You're not going to get that. That will never, no more. So, and this also causes problems with people that are trying to sell or refinance, because banks aren't underwriting them like they used to anymore. So that's another problem that we're seeing, that people that are going to sell or refinance because they have to now sell or dump the property because they can't refinance, and the bank's like, you need to put money into it. And so now they're like, well, let's just see if we can sell it and get out of it what we put in.
That kind of goes into my next question that I was going to ask you. Who is selling today, and why are they selling? Are they selling because they have to, or are they selling because they need to sell? Who are the what's the buy box on the sellers today?
I'll tell you what I'm seeing, and then you can tell us what you're seeing. I'm seeing a lot more are actual sellers. So last year, 2023, the end of 2022, it was a lot of people that I believe were rushing to try it. They've already missed the boat, but they're like, maybe we can still sell it at these high prices. And that didn't come to fruition, so they just gave it up. Where this year, a lot more people that are, I need the capital, I'm refinancing, or 2, I bought 2-3 years ago and I'm just done with this thing. This was supposed to be easy and it's not. So we're seeing way more, what I would say, sellers that are selling beyond I can get a high price.
So you're talking about sellers that need to sell, actually, not that want to sell. They need to sell. So they're more willing to accept the more reasonable offer.
Now, not all of them. Not all of them. Of course, there's people throwing out numbers or whatnot. I just think brokers and other people have gotten to a point where they're like, we're not doing that. Because we're not going to trade. You're going to waste my time, everything else. So I think it's way more. 2023, it was like 80+% were not actual sellers. They were just trying to get the high prices that already came. So yeah, what are you seeing right now?
Actually, very much the same thing. Plus, I see a whole bunch of lease-up deals, CO deals.
Yes, lots of those.
A lot CO deals, and I think those deals were underwritten back in the days where the rates were different, the interest rates were different, and the rates management was different. Look what's going on right now with REITs and the way they manage their rates. With the dropping in-store rates and no, actually web rates, right? They're dropping web rates, and that was not the case 2 years ago when those deals started to happen. So I think some of them, maybe not a lot of them, but some of them are facing with the need to refi because it was a short-term loan, like a bridge loan or whatnot, and they need to refi into the a permanent deal. And some of those deals were built in locations where it's overbuilt already, where there's plenty of other storages, and they not leasing up. Their velocity of their lease up is not what they expected. It doesn't follow their pro forma, and I think they might get a call or two from the bank and. Hey guys, what's up? What's going on with that a 4% a month lease? Because on average you're probably leasing at 2 to 2.5% right now, if not less.
We have 4 lease-up facilities, right? And they didn't go anywhere near projections, obviously, because 4 years ago. And so we see that. We planned on that. But I know a lot of our investors and people are calling, and they're getting capital calls from all over the place. They're multifamily deals, they're storage deals, things like that. So I know the market is really sensitive to it, especially in those fill-up deals right now, because they weren't filling up. And if you were priced to where you had to fill up at those rates, right, and that's really what it took to make it work, those won't work today at all. So
it's not happening. It's not happening.
And it won't. And so a lot of those people are feeling that.
Talking about capital calls, I start seeing a lot of YouTube videos from large investment groups putting out videos on what a capital call is and how to handle those calls, because they either already there or they know they're coming. So I think people that run into some issues like that will probably try to get out, but they're not going to get out at the market price today. They want to get out at the price that they underwrote the deal for. Right? They have investors, they have, they got to pay them back, with the cash flow, whatever, 2x on multiple, this and the other, all those promises. And I think it's going to be very difficult. And I think this is where, because we're constantly looking for some pain in the market, meaning where can we get the best deal from? What part of the market are we going after? Like, we can't compete with big boys, right? Public REITs, their cost of capital is different. They're underwriting, instead of 5 years, they underwrite to 25 years or to 20 years. So it's a long-term, a lot longer than ours, the underwriting. So we're looking at the part of the market where we can come in and where we see an opportunity. And I think some of those early lease-up deals today could be one of those deals as well, where there is an opportunity where somebody needs to get out, you come in, and if it's a good location and if the demographic works. But I think that's the area where we see a lot of new deals right now in the market as well. I also see a lot of development deals, land, already pre-approved with all the permits. Everything is done, shovel ready, basically. Go in and pull the permits and start doing the construction work. But once again, the prices that they're asking are not the prices that there are today, because they start working on that deal a year and a half, 2 years ago. So there's still a wide spread, I think, between what makes sense, what doesn't, between the bid and ask, sellers and buyers, and I'm just curious to hear your take on what would it take for the market to get more stabilized, for us to get on the same plane. What do you think?
I mean, how usually these work through these different cycles is the readjustment period takes time. So after 2007. And 8, it took time for the market to readjust and find a new mark. Now, during this readjustment period, this is actually where the opportunity is. And I've been trying to tell people this, it's hard because with investors, with everybody else, they're sensitive to the market. And so when the market's unknown, that's when they don't want to invest. But when the market's unknown, that's actually where the opportunity is, because if not, the market's pricing that value where it should be. So it's actually during the adjustment period of time. It's not when it's known, it's not after it, it's in the middle of the unknown, because then you can come and find the opportunity and place value at what can be done, and nobody's there to outbid you to, that's how the value is really created. That's how we see it. That's what we're trying to do. Now, it's harder to get capital to chase unknown, though.
I was going. That was my next question to you. How do you finance those deals? Yes, there is a value add. Yeah. How do you finance those deals?
Investors, they don't want to invest right now. They're following, these narratives, everything else, and it's understandable. Some of them are getting capital calls, so they're like, "Hey, I'm done." The problem is, though, they're looking and they're seeing the consequences of decisions made 3 years ago.
Yes.
So they're done, but now's not the time to decide to be done. It should have been 3 years ago when those decisions were made. So they're now making decisions when the opportunity is. It's the classic, right? You need to be fearful when others are greedy, and greedy where others are fearful.
100%.
And everybody says that, but then when it actually comes time, nobody does it. And it's so funny how that works, because everybody says, "Oh yeah, of course. Well, why don't you invest?" "I'm going to wait and see what happens."
Psychologically, it's very difficult to do.
Very difficult.
We are programmed to do what everyone else is doing. So if everyone else is buying, you want to buy. If everyone else is selling, you want to sell. You don't think the opposite way. That's why the contrarians are doing so well, because they can take advantage of this, right?
And that's what we did in 2008 and on. And, when people ask, "Oh, well," they look hindsight and they're like, "Yeah, if I could go back in 2008, 9, I would buy everything." And I'm like, "No, you wouldn't have." You say that because it's hindsight's 2020. But when we were buying deals were going down. We didn't buy deals when they were turning around and going up. We were looking at occupancy levels of 70%. And it's like, we think they've stabilized here, but rates have been going down for 2 straight years. It wasn't that they were turned around. For all we knew, occupancies could have gone down to 60%. So we had to underwrite and find deals that had value that we could make work at that time. At that time, it only looked like it was at a discount or a real bargain because you're looking at it from today.
Not in the moment, 100%.
You did not see a discount and a bargain at the moment. And that's where it becomes very, very difficult, because people say, "Well, I'm going to wait," or "It's not the right time, and I'll know when the right time is because the assets will show me." But then once it is, the markets have already priced it in. It's very difficult to do for people.
Are you a new self-storage investor and want to know what that facility is worth, what the risk is, how to underwrite it? Well, that's exactly what we do in a feasibility study. A feasibility study, we actually look at the market for you. We look at the finances, the underwriting, we show you where the upside is, the downside, and all the risk. That is actually what you can provide to banks to get capital and investors. It's a big worksheet which most banks actually require. So if you want to know what a storage facility is worth that you're looking at, come to us, follow the link in the show notes, and we will tell you.
I think the very important question is, what gave you the confidence in the midst of all the calamity and instability? What gave you the confidence to say, "Hey, Mr. Investor, this is the right time to buy. This is what we got to go in." Because I think a lot of people are struggling today. They feel the market is unstable, so they're kind of sitting on the sidelines. So I think that your answer is going to be very helpful to a lot of viewers, right? What gives you, or what gave you the confidence, what should give you the confidence to know that this is a good deal, regardless of what part of the cycle you're in?
At the end of the day, I talk a lot about this in my book, but the difference between extrinsic and intrinsic value, we basically stopped listening to the marketplace and what things would sell for and what they were worth and everything else. And all we did is say, if I buy this for this price, what am I getting for my money? And then we looked at the 3-4 mile radius and said, is there current customers and demand for this today? And will there be current customers and demand, in the future? Outside that, we forgot about everything else. We just got rid of it. I didn't care what the prices were. I didn't care what they were going up and down at. I didn't care what CNBC said. I didn't care what brokers said. The moment now is opposite. CNBC and the Wall Street Journal is like, there's huge, massive problems in commercial real estate. You should stay away. That's a buy signal, because once again, they're repeating what has already taken place and seen. They're years behind. That they should have been saying that 3 years ago, but nobody was. And so, that comes down to the big thing when I wrote The Self-Storage Bubble 4 years ago now. And we had the banks and over 1 million people, read that and viewed that and everything. That's when the time was to be like, no, there's an issue. Now that it's time to buy, though, everybody's out. Nobody's pulling the trigger, and investors are gone. So for us, you have to forget about all that other stuff and just look at the deal. As a investor that is investing with somebody else, like you or me or someone else, that can be really hard because you don't intimately know the deal, or maybe not even the value. So I get how that's really hard for investors as opposed to maybe operators, things like that. But it is that contrarian nature. So what are you doing right now to try to find deals and buy deals, even in the midst where you go, I know there's value, opportunity of a lifetime, but right now, banks, everybody else, it's people are worried or scared, and you're investors. What are you doing?
Couple of things. I'm sure we're not unique, but I just want to touch upon the investors first. Investors invest in a person. I think it's more investing in you versus investing in a deal, right? Because when you go on a webinar, you start, you're showing the pro forma, you're going into underwriting. Very few people actually do understand all the intricacies and all the details. So they're basically taking your word for it based upon the fact that they know you, they like you, or they trust you, or they've done deals with you. So in terms of the investments and investors, we don't feel it's a big deal today. It's an issue for us, at least. In terms of where we and what we're doing to find the deals, we adopted a very interesting strategy. I think is interesting. We are making offers on everything.
Everything.
We are making offers on everything that we feel works for us. Now, if I see, and I'm not going to go into details, but if I see a deal listed at $3 million, but it works for us at 2.1, that's where I'm going to come in. We're going to submit an offer, and before it was kind of unpopular to submit a lowball offer. And I'm not talking about that we are lowballing him. I'm talking about this is what makes sense. Because one thing that I don't want to do, I don't want to run into negative leverage. I don't want to buy at the cap rate that is substantially under or lower than my cost of capital. So if I go to the bank today, if I need to finance the property at 7.25 to 7.5, I don't want to buy a 6 cap deal today, unless there is a tremendous delta between market rates, facility rates, and what they're currently paying, and I can go in and I can immediately raise those rents 20, 25 to 30%. But more often than not, I just want to count on the fact of organic growth, 3-5% a year, managing the expenses, managing the, doing our SEO, doing the marketing, and just coming in with the offer that actually makes sense. And once again, like I said before, I call the broker and say, hey, do I even bother? Do you think this is gonna make sense to the seller? I know this is not what you're expecting, but this is what we feel confident we can get the deal done, versus somebody else who's coming in that don't have any experience. We also, another thing that we'd like to do to make our deal look better and look stronger, we put a lot more money down. We don't come in with 1%. We come in with $100,000, $150,000, $200,000 down payment. It is refundable, but it
looks stronger. It gives more confidence.
Correct. They know that we're going to close. They know that we have the whereabouts to close. So making offers on a lot more properties, and putting more money down, and not going crazy with due diligence time and the closing time. We used to ask for 90 to 120 days. Now we want to kind of stick to 75 to 90 days. We know that's the comfort level for most of the sellers. That's what we're doing. That's what we're doing.
Everything you just said, I love. Putting offers on everything, finding your point where you're going to buy it, finding what's acceptable, being real with the sellers. I can't express that enough. People are like, I haven't found any deals worth putting offers on. And I'm like, and you never will if you're not putting offers. Because there's no reason as a seller, and I'm saying this from my standpoint. If you said, AJ, go list your facility, I said, sure, 4 caps. Let's do it. Why not, right?
Are you getting offer at 4 caps?
Not going to get any offers at 4 caps. But it's almost like, why wouldn't you? Okay, so maybe we'd be like, we're not going to be crazy at a 4 cap, but 5.5, right? Understanding that it will probably trade at a 6 or a 6.5. And these are for large facilities in growing big second-tier markets. If I was in third-tier. But the point being is, I would not list it today at a price that I knew that it would trade for. I would list it for more, and I would want investors to get in, and I would want them to go through and say, here's our expectations, come to try to meet us in the middle. And that's what everybody's doing. So if you have an expectation that somebody's going to discount their own deal and put it on the market,
right away. That's not happening.
So what that'll mean is then you're just going to pass up on every single deal because nobody's going to list it at a trading price. So that what you said right there is so valuable and so important. I think another thing is to this your buy box, right? Being very clear on your buy box, and then that gives you the power and confidence to be aggressive when you need to be. That is a tactic that I just think always works. And it shows confidence. It shows that you know what you're doing, talking about. And when in today's market, that confidence, as we discussed before, is so important. Tell me about operations. How are your facilities doing in this climate?
Well, we are vertically integrated. So we have a management department within our company. We're using what's called a remote management. I'm sure a lot of people know what that is. We don't have a full-time managers. I know your system is a lot different. You operate larger facilities, and I know how you strongly feel about having a full-time manager or part-time manager or manager and a half, I think most of your facilities are.
Yeah, most of them manager and a half, but we do have three. We have three facilities that are remote.
Oh, really? Okay. So we our average facility is somewhere between 30 and 40,000 square feet, and we don't feel that we need a full-time manager sitting there and answering 4, 5, 6 phone calls.
You probably can't afford it.
And you can't afford it, right? Plus, it's an immediate value add. It's $40,000-$50,000 that you can add to the the bottom line to your NOI, which makes the facility immediately a lot more valuable. And we are currently we are about 94, 95, 96% occupied. Somehow we ended up to be at the top of the market in terms of the rates. So we're not aggressively pushing the rates like we used to, but still 3 to 5% a year is what we do. So what we do is actually we have a number of VAs. That's our call center. We have a number of VAs that run the operations, and then we have a number of VAs that are directly in touch with our boots on the ground, what's called. And boots on the ground, for those that don't know, is someone who works there as needed, who comes to the facility, clean the units, turn their units, overlocks the units, and stuff like that. So we managing ourselves, we find it to be relatively straightforward, relatively easy, and very, very effective. And certainly, the largest facility that we have was about 60,000+ square feet. We had a full-time manager.
And tell me about how's your occupancy right now and rates doing?
Well, just like I said, we have a portfolio in Maine. I checked this morning. We are at 95, 96, 97% occupancy. And in terms of the rates, I mean, I keep asking my partner David, and I'm like, Dave, we gotta get more aggressive on rates. They're like, no, we're already at the top of the market. We're already at the top of the market. So we're not going aggressively after raising rates, but just like I said, organically, somewhere between 3, 5, 6% a year is what we're gonna do regardless every year.
That's right about in line with what we plan. So if we have a stabilized facility, we're planning somewhere around 4 or 5% rent growth. Unstabilized facilities are all 10+%, but that's because we're doing catch up. We're trying to get to the top of the market and everything. So I think that's realistic. Now, tell me, the markets that you're in, are these small markets, medium-sized markets? What do those look like?
We sold a whole bunch of deals last year, just like I said, and some of them were in the secondary markets, but primarily we're in the tertiary markets. Primarily, we are where there's some competition, not a lot of competition, and we operate in markets where there are no REITs, so we're not competing against big boys. We don't have that problem. So I would say very typical tertiary market where plenty of land, someone else can come in and build tomorrow, but they're not going to because there is not that much of a demand. Our actually current buy box is we trying to move out of those locations to go into more of a secondary or more robust tertiary markets, and that's the plan for this year and next year. But currently we are in a very tertiary market.
That's good to hear that you have occupancy levels at that in those tertiary markets. Means you obviously did your market research and made sure there was strong demand. I know there's a lot of people in some tertiary markets that maybe overestimated demand and that they're seeing much weaker. So congratulations on that. You're running a good shop.
Well, thank you. But I think, there's two sides of the coin. A lot of times people are walking away from deals where they see let's say 12 square feet per capita, 14, 15 square feet per capita. And now, oh, okay, so this is not a good market. This is not a good market and we're not going to go there. We're not afraid of those markets. We're not afraid of those markets because we look at every market actually every sub-market within the market where we operate. So maybe for the 5 mile radius, it could be 14, but where we at in 3 mile radius, it could be 8. So we're not getting, and that's the lesson that we learned in our first facility. And I'm going to tell you, you're probably going to laugh. The first facility we bought in Midland, Michigan, the 3 mile radius, the square feet per capita was at 42.
Wow.
At 42, we never dropped below 97% occupancy. And people will go crazy, like, you got to be kidding. I mean, that's not the place you want to go. And so all I came and I spoke with the owner and I said, hey, for the last 20 years, you own the property. What was the lowest occupancy that you ever had? He's like, well, we never dropped less than 85%.
Markets are wildly different. And I've told this story before. We were looking at developing in a site we thought was amazing. It was under 8 square feet per capita. We're like, this is going to be awesome. It was a growing market. And then we had another one that we were debating and had 20 square feet per capita. Well, we went and looked at both markets. The one that had 6 square feet per capita had vacancy and did not have rent growth, and the one that had 20 plus square feet per capita had no vacancy and rent growth consistently for a decade.
But why is that, AJ? Did you analyze that? Why?
So I think it's a few things. It has to do with the growth of the market, the income of the market, but the utilization. So typically we'll see that in lots of times the West Coast and the South, they utilize more storage based upon how they live, how they use land. HOAs, right? All sorts of different things like this. If they're out doing things. So the demographics and how they use land and what they're able to do with their land and then the growth will dictate that demand. And in some areas, you look at it, and I talked to Mike Burnham, everybody. You can go back and listen to the podcast. He's got the largest privately held storage company ever. And we talked about how he's like, all right, get this. And it was a great thing that he showed and brought up. He's like, in New York, the average square feet is 7 square feet per capita in Manhattan, right? And he's like,
one of the lowest in the country.
Yeah.
Yes.
And he's like, now you come out here to Boise, Idaho, where I live. That's why we're talking about it. It's 25 square feet per capita. And he goes, who has more storage? Well, obviously we do. And he goes, but here's the thing. How many doors per head? And when you looked at how many doors per person, guess what? New York has more doors per person than we do, even though we have 4 times the amount of storage. Now, people may go, how's that possible?
It's because of the density of the population.
The size of the units.
The size of the
So if you have a 10 by 20 versus a 5 by 5, that 5 by 5 on a 20 by 20 is how many 5 by 5s?
Yeah, 4.
So that's 4 times as many doors than this one unit with one person. That's why and that's how. So a lot of people overlook at these little things and they are taking one market to the other. You can't do that. It doesn't work like that. And so I love that you mentioned that. You zoomed right in. We got down, we understood the local market and found those advantages. That is really important today because today demand is not evenly spread like it was 3 years ago where everything was 90+%. And so a lot of people are shocked when you have a market that's 18 square feet per capita, but yet it's still full. Rates are going up.
Also, I think another thing, a lot of people are relying on Radius Plus today and other services like that. But I think it's very, very local. Like you said, you got to go down there. You got to take a look at it. You got to walk the competition. You got to talk to the managers, talk to the owners, and get a feel for whether there will be demand. Also, a lot of times with those mom and pop deals, they fully occupy because they never raise rents. They know everybody in town, they relatives, friends, whatever, but they don't want to offend anybody. And you also need to assess can you raise rents? Because the places where we tend to buy, the rates are usually suppressed across the board. Across the board. It's not just that particular facility. It's all of them in town are 10 by 10 at $60. And you say to yourself, wow, I can probably bump it up to 80 and it's still going to be cheap. No, you can't.
Customers won't take it. They literally won't buy.
They're not going to take it. Exactly.
We look at that too a lot. And in today's market, those things are really important. It was easy when everything was full and everything was going up. Nobody really had to do analysis like this. And then they were all just successful. And it was like, oh, this is easy, right? Now, it's important to know, though, that was not normal. So people are like, oh, I'm going to wait till it returns back to that.
Are we ever going back to that or no?
I don't think we should. I think that was actually a bad thing because it was such a market inefficiency that it created problems. We should never be in a situation where we have 96% occupancy and you're raising rates double digit in every single market in the United States. That shows that the local markets don't even matter anymore, which that is not something that can even keep up or keep going. So I think it was a bad thing. I don't think it will go back to that, and I hope it doesn't. For the whole history of storage prior to those 4 years, 5 years, that had never happened before.
It never happened before.
No,
correct.
We had never even hit like 90+% occupancy. Then we had 3 years at 96. And that was raising rates double digit every single year. Nothing like that had ever happened. It was unsustainable. And I think it created a lot of the problems where people are like, oh, the assets aren't doing good and self-storage isn't performing. And I'm like, compared to what?
Compared to the last couple of years.
Because I'm like, as of right now, we're still in historical norms and highs. And so when you look at that, it really changes how you view the assets and performance. And I think a lot of people were just, it's, oh, well, I'm just looking at what happened 2 years ago. And you're going to miss a lot of opportunities if you're doing that because it's just not working, as you know and as you're looking.
100%. 100%.
Tell me right now, in today's market, we've already almost spent an hour here. What should people know? And what is, if you were prioritizing right now when you're going out to find a deal, what is your top 2 priorities when looking at a deal?
So first of all, I want to say to investors or someone who wants to get into the industry or who just starting, just go do it. Go do it. Don't wait. Don't think that there's, you need to know everything about it because you're never going to know everything about it, and it's a good excuse not to do it. So find an excuse how to do it. Just go and do it. Go buy your first facility, do a research, join the mastermind. H has got a phenomenal mastermind. I'm a part of it. Talk to other people, investors, operators. Just go do it. You're going to learn so much on it. That's number one. Number 2, top 2 things we're looking for. Number 1 is location, okay? Because you cannot substitute a good location and whether it's a good market, bad market, and it's one of the most important things is location. The second most important thing that we're looking for delta between the market rates, facility rates, and what actual tenants are paying today. Because for us, this is the easiest value add. You can buy a facility and you can literally, if it's been undermanaged, and if the owner never raised rents, you can literally come in and raise the rents 20, 30, 40, 50% on day one. Yes, there's going to be some unhappy tenants there, but that's the way it is. And you can bring those rates to the market, and that makes the facility a lot more valuable in the long run. So we're looking for the location. We'll look for the delta in the rates. We're basically looking for mismanaged, mispriced assets. That's what we're looking for. Mismanaged assets. If we are looking at the fully stabilized assets where you can only grow organically, which is probably the case on a lot of your facilities that you're looking at, 60, 70, 80,000 square feet, the operators tend to be more sophisticated and more knowledgeable, or the third party, that they might be using. So the cap rates on those deals should be somewhat different than on a value add.
Higher.
Higher, yes. They should be higher. They're not, but they should be higher.
I'm actually totally okay paying a 4 or a 5 cap as long as it's not a good deal. And people are like,
right.
What? That's not how it's supposed to work. And I'm like, you give me a good stabilized facility, I want to pay an 8 cap today. I'm like, I'm not paying anything. And they're like, but why? That doesn't make sense, but it's true.
No, but seriously, AJ, why? Because there's not much upside. You can only grow organically.
Exactly.
There's not much upside there.
You make your money when you buy. That's the only way to make money. So you have to pay at a lower price and you have to get it at a discount to make money because your cost of capital, everything else, you can't otherwise. Deals that are mismanaged and they're bad deals, I can make a lot of money not on the buy. So I can actually afford to pay more because of what we can do in it and the opportunity.
So those are the two main things that we're looking for: locations and mismanagement on the rates, of the rates, actually.
Awesome. Well, with that, man, where can people find you? Where should we send people?
SafeStorageUSA.com. They can find our website and they can see all of our locations, and they can come in, sign up, start getting some letters, and start getting in with us in terms of the investments. Storage Doctor on the Instagram. I try to combine those two passions of my life. I used to be a doctor, now I'm in storage, so Storage Doctor. Listen, once again, congratulations on your success.
You as well. Seriously, I mean, what you've done, after 50, you went and all of a sudden in just a matter of a few years, you own 6 assets. I mean, that's an incredible feat. So congratulations to you, and thank you for coming on here and sharing your knowledge with others.
Thank you for having me, man.
Absolutely. We'll talk soon.